What's the biggest factor that determines retirement success? Is it really just luck? Well, here to talk with me about that is Dana Anspach from Sensible Money. Dana, welcome.
Hi, Bob.
Pleasure to have you here, and it'll be a pleasure to have you tell us whether is it just luck or are there other factors at work here?
Well, luck certainly has a lot to do with it in terms of how long our money lasts and the wealth that we have at the tail end of retirement. The actual year we retire and the performance of our investments early on in that journey does have a lot to do with it. But it's not entirely luck. There are some factors that we can do that can improve our outcomes and make us less unlucky if we should get an unlucky scenario. And that's what I thought we'd talk about today.
All right, great. I'm all ears.
All right. Well, I am going to share my screen. And what I wanted to start off with is a paper that came out in 2019. It's called Chaos and Retirement Income by Jim Sandage. And he has some fabulous information in there for those of us who really like to geek out on this kind of stuff. But I wanted to start with just figure 6, which has this graph called the butterfly effect on it. And here he's showing a scenario of the brown bars are someone who retired in 1966. They had $1 million portfolio, 50% stocks, 50% bonds. They were taking a 5% initial withdrawal, so $50,000 a year of cash flow out of the portfolio, and increasing it 3% a year to keep up with inflation. And so this 1966 retiree, the brown bars show you their remaining portfolio value each year after taking out that 50,000 plus the inflation adjustments. And we get from 66 to 90, and they have essentially depleted their portfolio. Now,
Seems unlucky to me.
unlucky, right? Exactly. Now, that retiree, if they had retired 1 year later in 1967, well, look how their luck changed. This blue line, they did exactly the same thing, invested exactly the same way. And this blue line is now charting their ending portfolio values. So they have a substantially larger amount left at the end of that time frame. Now, granted, they're 1 year behind, but even if that next year was a poor one, they've got a lot more cushion. And this unlucky retiree, this 1966 retiree, we could just say, well, that wasn't great luck. But on the bright side, there are things that we can do so that if we retire into an unlucky scenario, we can be not quite as unlucky. And that's what I want to talk about is, okay, how do you prepare your portfolio should that happen? I think we have this idea that, we're going to know. And oftentimes we don't know that we will be retiring into, one of the worst times in history, or we don't have a choice. So it could be that, during the Great Recession, we're laid off, or a downturn comes and a stock market bear market comes along, and it wasn't our plan to retire then, but we may not have had a choice. So diving into another piece of research, this is a 2016 paper that's also available online. And I know you're going to put links to this research, so that people watching this video can find it and read it. But this is a paper put together by what is my firm's portfolio partner, a company called Asset Dedication. And they were studying different portfolio strategies. And what you're seeing on the graph on the screen here is a comparison of 3 strategies, A, B, C, and the S&P 500. Now, strategy A is something we don't hear much about. Minimize the worst case scenario, abbreviated as minimax. What on earth does that mean? So that's a strategy that says, well, if I get the worst case scenario, how do I make it as least worse as possible? Or looking at the worst times in history, what portfolio held up the best, even during these horrible bear market times? So that was strategy A. Strategy B, maximize the Sharpe ratio, is a technical way of describing what's more considered traditional portfolio management, is the efficient frontier. How do I make a portfolio that maximizes returns for a given level of risk? And so you're really looking at, strategy B is, how do I maximize my potential average return over time? Strategy C is, well, I could care less about risk, just I'm going for it. Like, what strategy maximizes my expected return over time? And then the brown is the S&P. Now, in these dashed lines, you're seeing the average returns. So they're looking at all the 1-year periods over, let's say, this 40-year horizon. They're saying, well, if we average all those together, the red line, strategy C, had the highest average returns, which makes sense, right? Your goal was to maximize your expected returns. Well, the next line, strategy B in the dash, well, it had the highest, second highest average returns. Well, that was its objective, was to maximize returns, but actually to bring some consideration for risk in. Then we look at strategy A, which was, well, I want to minimize the worst case. Well, its average was a little bit lower. And then we have the S&P, which in terms of average returns, it didn't do as well as the top two. Now, on the downside, if we look at strategy C, which had the highest average, it also had the worst downside. You'd be down over 50% in a single year. If that was your first year of retirement, as we just saw in the previous paper, that could be devastating. So one of the things that Jim Sandage really illustrates in his work is that one of the biggest factors that determines your success is not achieving higher returns on average. It's, how do I achieve higher returns in the downside scenarios? So how do I make a bad year not as bad? That has a bigger factor for your success in retirement than anything else. And so here we're seeing that trade-off. If I look at strategy B, a more traditional portfolio management, I'm going to maximize the average return with risk as a consideration, strong average returns, but again, significant downside in any 1 year. And if that occurs, the year before you retire or the year you retire, that's going to have a big impact on you. But the green, minimize worst case, did its job. When we look at the worst 1 year, the worst 5-year return, even the worst 10 years, so you get a really bad decade, well, it wasn't as bad. And so this is where we talk about luck. You can improve your outcomes in an unlucky scenario depending on the portfolio design that you use and the actual behavior. So your behavior, regardless of these strategies, you have to be able to stick with the strategy to see the outcome. So if you have an unlucky year and you panic and change your investment strategy, that's not going to help. So your behavior impacts it. But what I really like about this is not trying to say that one strategy is best. It's that I think there's a lot of confusion out there. And when you understand that portfolio strategies have different goals, you get a little bit more clarity about why one person might be saying this is the right way to go and another person might be saying this is the right way to go. If your goal is to maximize average returns, strategy B, I think when you're accumulating, works great. In most markets where we don't get a worst case, you're going to be just fine with that strategy throughout retirement. But if you really want to make sure that you're okay no matter what, that you're going to be able to have the best odds of maintaining your lifestyle, then there are other approaches that do a better job of, making sure that a worst case scenario isn't quite as worse. And I think you really, as you're entering retirement, you just want to be conscious of that and really be aware of what is the portfolio strategy design that I'm picking and why, and is it, going for the goal that I want it to.
Yeah. I want to talk about the other approaches, especially folks who might be focused on dividend income or interest income as a way to create income in retirement. But before I do, Dana, with respect to the first slide that you showed, um, and you mentioned behavior, the notion that you would maintain a level 3% inflation adjusted withdrawal rate during bad markets seems to me like there's theory and reality that you might change your behavior if you were experiencing these down, that you wouldn't end up with $8,500 at the end, knowing full well that that you had to adjust your spending in order to have your portfolio last a lifetime.
Absolutely. And in his paper, Jim talks about active management, but it's not active management in terms of how in our industry we might typically think of it in terms of picking stocks or, changing asset classes. He's really talking about how do you adjust your cash flows. So, we had people retire in December 2007, right before the Great Recession, and we skipped these inflation increases for sometimes up to 5 years. Now, that coincided with a period of zero inflation. So it really had no impact on anyone. But skipping those annual increases and knowing when to skip those annual increases is a form of cash flow management. Jim in his paper also talks about your stock to bond allocation. And Michael Kitces has some work on this he calls a bond tent. So you could have, a higher allocation to bonds as you enter retirement, and you would be using the bonds that mature for your consumption needs. And then later in retirement, you might let your portfolio, as you're spending the bonds during a down market so that you don't have to sell stocks, your equity allocation gets a little bit higher. And that is also a form of, some will call that active management. It's really managing the whole allocation. It's not trying to trade stocks and pick the best asset class, but it's being very thoughtful around what type of approach is going to help me weather those retirement red zone years, the 5 years leading up to and first 5 years of retirement. But absolutely what you said, managing those cash flow increases in a thoughtful way, you could preserve most of this portfolio value, even in this scenario, even in this 1966 scenario.
Yeah, so you have levers to avoid the unluckiness, and what looks really bad in theory may not be as bad in reality, assuming that you're prudent about managing those levers.
Exactly.
Yeah. So talk about some of these other approaches. Many folks, I mentioned dividend income, interest income, REITs. People are looking at other ways to generate retirement income.
Yeah, I did a webinar recently on, how do you turn your investment portfolio into a regular retirement paycheck? And I often get the question of, well, can I just buy dividend paying stocks and live off the interest and dividends? And certainly you can. And now that interest rates are a little higher, right? You can say, oh, I could put all my money in treasury bills and just get that 5% yield. Can I just do that? You can. It's not obviously guaranteed to stay that way. So we went through almost a decade of 0% yields. So I used to get that question a lot back in the early 2000s. Well, can I just buy interest bearing things? And at that point, I remember it was about 2005, 2006, money markets were paying 6%. And so, but then if that was your approach and suddenly interest rates went down to zero over the next 2 years and then stayed there for a decade, you would be forced to either use up your principal value of your portfolio for consumption or switch to some other strategy over that decade because there was no interest income to be had. At the same time, if that was your approach going into the Great Recession, well, a lot of companies slashed dividends. They either cut the dividend or paused it altogether or decreased it substantially. And when they did that, the stock price also went down. So if you needed consistent cash flow, suddenly you were at the point where your cash flow could have gotten cut in half. And now if you had to sell some of the underlying principal to use that for consumption, well, that was down substantially. And so if you're just relying on that cash flow for, variable income, I think that can be fine. But you in a downturn, right? It's not the strategy that's going to help bring consistency to your cash flow.
Yeah.
Same, I recently had a potential client say, well, I talked to another advisor and, they said I should put a significant portion of my portfolio in private REITs, real estate investment trusts that are yielding 6 or 7%. Well, those can produce nice cash flows. And I have seen how they perform again during the Great Recession. Many of those REITs eliminated the dividend and they're not liquid investments. So you got no cash flow for sometimes many years and had no way to redeem any of your principal. You just had to wait it out. So in terms of the consistency of cash flow, I think those approaches fit a little bit more in line with, what we would call the strategy B. Over most normal scenarios, they may help you maximize the average return. But if we get a downside scenario, that consistency of cash flow that you really want in retirement may not be there for you.
Yeah. You talk about consistency, but you've also talked about the variability of cash flow needs in the first 10 years of retirement versus, say, the second 20 years. Talk more about that.
You and I were having that conversation before we started this recording. And so, I call it the opportunity years, usually between the year you retire and now about 75 when RMDs have started. There's a lot of moving parts. Transitioning into retirement, is a big life change. Some people choose to move, they may buy a vacation home, their hobbies may change, they may do a big remodel. You're traveling a lot during early retirement, or perhaps you're, helping out the kids, you're visiting them more. There's just a lot of moving parts still. You don't retire and things just flatline. It rarely works that way. However, fast forward to mid 70s and beyond, those moving parts tend to slow down. You're getting Social Security. If you have a pension that started, your required minimum distributions have started. You have likely settled on your retirement home, where you're going to be probably for many, many years. And so things tend to stabilize at that point. And when you're in those first 10 to 20 years, Social Security might start one year and a pension a different year. Or if you're married, income retirement dates can be different. The amount you have to draw out of your portfolio can be double one year what it is the next. Once you're both over 70, it stabilizes. So I think there's just a lot more work and intentionality in the planning that has to go into those early retirement years.
Yeah. Also top of mind for me is that you and I were recently at the Alliance for Lifetime Income conference, and there was a good amount of discussion about the role and use and value of guaranteed lifetime income in a portfolio. Care to share your thoughts about how those instruments fit in?
Yeah, I really enjoyed that conference, and I love, the concept of protected income as an asset class. So we talk as financial advisors a lot about portfolio risks, and typically that's around the volatility of the portfolio. But there's all kinds of other risks that we face in retirement in terms of making our money last as long as we need it to. And annuities play a unique role. They are a very unique vehicle in that they can guarantee cash flow for life. And so thinking of that as its own asset class of protected income, I think helps maybe set it aside from, it's not like I'm going to compare this to bonds, or I'm going to compare this to a stock portfolio or to real estate. It's something different. It does something different. It has some very unique attributes to it that can help make sure the cash will last, for your whole life. And so I really like that concept of framing it in terms of protected income, and deciding, like, when do you most need guaranteed income? My view on it is, a lot of research has shown that our financial literacy declines as we age. So our confidence can stay the same or increase as we get into our late 60s and 70s, but our actually ability to make financial decisions as well as we could before will decline. And so I like the idea of having more guaranteed income as we get into our 70s. And so that's where I think that asset class can really fit in. And if you're building that portfolio on the front side of retirement, you could buy a deferred income annuity where the guaranteed income starts a decade later, or you could set aside a part of your portfolio where you would say, at 75, I'm going to turn that into an immediate annuity at that phase of my life.
Yeah. So, a lot of people criticize annuities, but to me, they're neither good nor bad. It's just how and when you use them and the appropriateness of their use. And to me, it's a matter of customizing it, right? Customizing the plan to meet someone's goals, right? Personal goals and circumstances.
It is, annuities, for many years, there was a certain type of annuity that was a very expensive product, a variable annuity that would often be sold as kind of a Swiss Army knife, as if it could do everything. And I think, annuities got a bad name, undeserving. When you really look at their place in a retirement portfolio, they're a very unique vehicle. They are their own asset class. I do think they have a place. I think they can bring, we measure so many things in terms of portfolio returns, but you could also measure a portfolio in terms of its level of retirement security. I'll use that. I wish we could have a standard metric. And an annuity can improve that. It can improve the level of retirement security of your cash flow. So that's pretty powerful, but we're just conditioned to think of things in terms of the portfolio return. There's other metrics that I think are even more important in retirement.
Yeah, it's so interesting. During the accumulation phase, everyone's focus is on returns, but during retirement, it's really a matter of how secure is my cash flow and how, right, and what will it guarantee that I am able to maintain my standard of living.
Exactly. Yeah. And we don't have a good industry-wide metric yet that we use that can assess that. But I think that's really important. And I'd love to see the industry move that direction.
Right. And I think one of the terms that you use and others have used is coverage ratio. And at the moment, it seems as good as any to me as a term to identify your retirement success. But
yeah, coverage ratio can be used in terms of how many years of cash flow do you have covered by guaranteed investments. And then I like the term fundedness. So the same measure or metric that a pension plan uses, and they send out their annual statement and show you how well funded the pension plan is to meet its goals. Well, that same type of analysis and metric can be applied to a household. And so when I say an annuity improves your level of retirement security, I'm actually referring to a metric called fundedness, where we can plug it into a client's plan and say, yeah, that improved your fundedness, meaning you're better funded or more well funded for your retirement goals than you were without this product.
Yeah. Well, I know we jumped around a little bit, and Jim Sandage would be proud because he's very fond of the chaos theory. But is there anything we missed or anything that you just want to sort of reemphasize?
Oh, if there's anything I want to emphasize, it's that, there's so much information out there. And I think when you really understand that a lot of the things you read or hear might be great ideas if your goal is X. And so I think where the confusion comes is a lot of portfolio and investing advice isn't framed in terms of the goal. Who is it really for? Is the goal maximizing returns? Even if the goal is maximizing returns, is it over a day, a week, a month, or is it a 10-year strategy? And so we can hear conflicting advice on the same day. It might all be great advice, but each piece of advice might be someone with a different goal or objective.
It's always a pleasure having you share your knowledge and wisdom with us, Dana. Thank you.
Thank you. I appreciate it.